The numbers are in and they've completely flipped the script on where interest rates are heading in Canada. For months, markets, analysts, and mortgage professionals have been confidently predicting that rate cuts were coming. But after this week's new job report, those hopes just took a massive hit. Canada's labor market came in way stronger than everyone expected. And now economists are warning that future rate cuts might be off the table altogether. This isn't just another economic update. This is the moment that could reshape how quickly, or if at all, the Bank of Canada begins to ease pressure on borrowers. Because when you look closely at the data, it's not the kind of report that says, yeah, it's time to cut. In fact, it says the exact opposite. Let's rewind for a second. For most of this year, the narrative was pretty clear. Inflation had cooled, GDP growth was slowing, and households were feeling the squeeze. That combination had the markets betting heavily that the Bank of Canada would start cutting rates soon, maybe even before the end of the year. Investors were pricing in a 70% chance of a rate cut by the fall. And for homeowners, that offered a glimmer of relief after 2 brutal years of high borrowing costs. But here's the thing, that entire outlook depended on one key assumption: that the economy, and especially the labor market, was finally starting to weaken. Because a weaker job market means less wage growth, less spending, and ultimately less inflation pressure. And that gives the Bank of Canada room to start easing. So when September's job reports landed and showed a stronger than expected job gains, stable unemployment, and rising full-time employment, it completely shattered that narrative. Suddenly, instead of debating if another rate cut will happen, economists will even see a cut at all in 2025. This report changes everything. It challenges every forecast, every mortgage rate prediction, every assumption homeowners were hanging their hopes on. So that's what we're going to talk about in this video. We're going to break down exactly what the new data shows, why it's such a problem for the Bank of Canada, and what it means for your mortgage, your payment, and the entire Canadian housing market moving forward. Because the truth is, this report doesn't just affect policy, it affects your pocket. All right, let's break this down, because this isn't just good job data. This is the kind of data that sends shockwaves through the financial markets and makes central bankers very, very nervous. In September, Canada added 60,000 new jobs. That's not just a rebound, that's one of the strongest monthly gains we've seen this year. Economists were expecting modest growth, maybe 10 or 20,000 at most. Instead, the economy blew those forecasts out of the water. The unemployment rate, it stayed steady at 7.1%, holding flat from August. Now that might not sound impressive, but here's what matters. It didn't rise. And that tells the Bank of Canada one thing: the labor market isn't cooling as quickly as they had hoped. Most of these gains came from full-time work, and some of the biggest jumps were in manufacturing, which added nearly 28,000 jobs on its own. We also saw strength in the public sector, healthcare, and agriculture, especially in Ontario and Alberta. Put that all together and you've got a job market that is still running hot, even after 2 years of aggressive rate hikes. Not everything is booming. Over the past 3 months, total unemployment is still down about 45,000 jobs. So this one strong month doesn't completely erase the broader slowdown. But markets don't trade on 3-month averages. They trade on momentum. And the latest momentum says Canada's economy still has fuel left in its tank. Here's why this matters so much. When the Bank of Canada raises interest rates, they are trying to slow demand, make borrowing more expensive, cool spending, and reduce inflationary pressures. But if the job market keeps adding tens of thousands of new positions, that means businesses are still hiring, people still have income, and the spending stays alive. And that's not what you want if you're trying to bring inflation down faster. Wage growth is still running around 3.3% year over year. That's slower than before, but still too high for comfort. So if you were sitting at the Bank of Canada right now, this report basically says you don't have permission to cut rates yet. And investors got the message immediately. Before the report, markets were pricing in about a 70% chance of rate cuts by late 2025. But within an hour of this data dropping, those odds fell sharply. Bond yields jumped, the Canadian dollar strengthened, and Bay Street economists started publishing notes titled "Rate Cuts Just Got Delayed." One TD economist put it bluntly: this report likely means the Bank of Canada stays on hold longer. The path to rate cuts just got a lot narrower. Translation: if you were banking on lower mortgage rates by early 2025, you might be waiting a lot longer than you thought. But here's what makes this tricky. The data isn't all rosy. Total hours worked dropped by 0.2%. Youth unemployment hits 14.7%, the highest in over a decade. So it's not perfectly healthy job markets, it's imbalanced. Some industries are thriving, others are struggling, and that makes the Bank of Canada's job even harder because they have to make one policy that fits every uneven economy. Remember, the bank's ultimate goal is a 2% inflation. And while we've come down from last year's highs, inflation is still hovering above 3%. If the bank cuts rates too soon, it risks reigniting the very thing that it's been fighting for over 2 years. So this report is like a flashing yellow light. Proceed with caution. The Bank of Canada now faces an impossible choice. Cut rates too soon, inflation comes roaring back. Wait too long, the economy stalls and borrowers start to break under pressure. It's like landing a plane in a storm. Move too fast, you crash. Move too slow, you run out a runway. That's the balancing act they're facing right now. So what does this mean for Canadians? If you're in a variable rate mortgage, don't expect relief anytime soon. If you're renewing, brace for rates that look a lot like today's. And if you're buying, know that higher for longer just got another boost. This job report gives the Bank of Canada permission to wait. And that waiting game could reshape everything from housing affordability to investment sentiment for the next 12 months. All right, let's talk about what happens next, because after this report, every economist is asking the same question. When will the next rate cut actually happen? The answer depends on which path the economy takes from here. Scenario 1, the waited out scenario. In this case, the bank holds rates steady through all of 2025, maybe even into 2026. Why? Because job growth remains strong, inflation stays sticky, and the bank decides to wait it out. It keeps inflation contained, but keeps borrowers in pain. That's our current path, and it's the most likely outcome right now. Scenario number 2, the soft landing scenario. Here's a hopeful one. Job growth cools slightly, unemployment edges up, and inflation finally returns to 2%. That gives the bank enough confidence to cut rates slowly, maybe late in 2025. Mortgage rates start easing, markets stabilize, and housing finds balance again. But this would require several months of weaker data. We're not there yet. Scenario number 3, the hard landing scenario. This is the wild card. If the economy suddenly falters, unemployment spikes, spending collapses, and housing freezes, the bank could slash rates quickly. But that would mean crisis, not comfort, because rate cuts in a recession don't signal relief. They signal that something is broken. So where does that leave us? This job report doesn't just change the numbers, it changes the story. For months, we've been preparing for relief, but Canadian labor markets just reminded us it's not done fighting yet. And until it shows real weakness, the Bank of Canada isn't moving an inch. If you're a homeowner or a buyer, focus on what you can control, your budget, your timeline, and your strategy. Even if rate cuts are off the table for now, how you prepare today will determine how you thrive tomorrow. This is all broken down in a video that I previously done where I talked about fixed versus variable rate borrowers in a video. So make sure you subscribe, hit the like button, and let me know in the comments. When do you think the next cut will actually happen? Thanks for watching, and remember, in the world of interest rates, what matters most isn't what we hope will happen, it's what the data tells us is happening right now.